Hey everybody, Jordan Schwartz here with Strategic Wealth Designers, and today we're talking about an awesome topic. What kind of a rate of return should you expect, and how you should look at your money and where it's going to take you in the future. Okay, so we're talking about rate of return. Now, what I would do is I would break this up into three separate subsets. Now, I hate this language because, again, a lot of traditional generalist brokers use this, but if we want to, we've got three different buckets. Now, you all know I'm a lefty. I am not an artist, so please forgive me. We have conservative, moderate, and aggressive money. Now, we know, obviously, as we move along the spectrum, we take more risk, but we can get a higher rate of return. Well, the reason why I like to classify performance in this is there is a spectrum of growth. Basically, if we look at the stock market over a 100-year period, the worst anybody could have ever lost in a year is minus 60%. The best they could have done is they could have averaged, or they could have gotten a 40% return in 1 year. It'd be cool to average a 40% return. If you hear that and someone says that, run very fast. What we want to do is we want to plot ourselves along the way. So, as we look at these spectrums right here, we know that with a certain level of risk, we're going to get a certain level of reward. Now, here's the thing we got to make sure that we're doing, and this is the big one. You got to make sure that your portfolio is efficient enough to where, yes, you take a worst case scenario of loss, but are you getting an average rate of return relative to that? So we got to first categorize what do these different numbers mean from a worst case scenario. If you're building and designing a portfolio, it's all based upon risk, knowing what your risk comfort level is, because what happened for a lot of people in 2008 or during the COVID drop or the dot-com bubble, any of those massive drops that we saw in the market, people didn't know what the worst case scenario was in their portfolio. So we've got to first know the different thresholds of risk that somebody can take and ultimately how their portfolio does. So if we want to think about it, the number I like to use is this right here. Now you could say a range of minus 50 to minus 60%. This is about our worst case scenario that we're going to see. We saw about a minus 50% drop in 08 from high to low, and we've seen 60 before in the past. So we want to make sure that we're categorizing based off of these numbers. Well, what do we consider conservative? Because your definition of conservative and mine, it's probably different. Everybody's number is different. So first and foremost, whenever we think of conservative, I evaluate conservative as a minus 10% loss or less. Now, if you wanted to, we could have a new bucket over here, and we could call this our safe bucket, where we don't lose anything. But if we're thinking of traditional buckets of risk, conservative, moderate, aggressive, I don't consider conservative 100% safe because there's still a little bit of risk with it. So, minus 10% for conservative. Well, where do we put ourselves with moderate? To me, moderate means about half of the risk of the stock market. Right? If the market falls by 50, we lose about 25%. And then aggressive right here puts us at minus 50%. Now here's where the fun happens, the magic happens of the portfolio. We know what our worst case scenarios are for these 3 to 4 different groups right here. So what's a reasonable rate of return to see, okay, we're taking a level of risk, are we getting an appropriate reward? Now first and foremost, if we have a minus 10%, this one right here, we can see average returns of somewhere between about 5 to 7% per year. So by us taking a loss like this, we could see average returns of about 5 to 7%. Well, what about minus 25%? What about our moderate money? And if we look at this, a reasonable expectation is going to be returns of somewhere between about 7 to 9%. We take more risk, we get a higher reward. And then if we go over here to aggressive, we can go minus 50%. And again, if you're an aggressive investor, this number doesn't matter as much. What matters more is this over here. And what we want to see is somewhere between a 9 to 12% return. And if it's higher than that, great, but we want to at least see that for our expectation for a rate of return. See, what's more important is not just these numbers, these thresholds right here, but whether or not your portfolio actually fits within it. See, what happens for most people is their portfolio is a combination of stock mutual funds and bond mutual funds. Maybe they're using ETFs. Well, typically that's going to put them in the moderate to aggressive range. Bonds are not safe or conservative, they're safer than stocks. Bonds really would be somewhere in this moderate blend right here. So if we're thinking about our portfolio for a second, these numbers are great right here. These are reasonable rates of return that you can expect and reasonably see on your portfolio. But the biggest thing, and I'm going to draw it right here, how efficient is your portfolio, right? How efficient is the portfolio? If you've got a really efficiently built portfolio, these are reasonable expectations for rates of return. Now, if you're hearing somebody say, well, you could take this level of risk and get this reward, that doesn't really exist, right? If we think about the spectrum of risk versus reward, any level of risk you take, you get a certain reward. And as you move along that spectrum, maybe you can outperform that a little bit by having the right investment groups and classes of tools that you can use. But besides that, really there's only so efficient that your portfolio can get where it doesn't really make an impact after it. So the biggest thing would be, yes, these are the returns that we can see, but the most important thing that you should ask yourself the question of is my portfolio efficient? If you're not sure of that, you can go ahead and subscribe to this video so you can get awesome content just like this. And if you have questions, send us an email at swdgroup.com.